4 years ago, I did something a little unusual. I took $100, a single bill, and split it 5 ways. Stocks, REITs, crypto, gold, index funds. Each one got exactly $100, and then I left them alone. No checking every day, no panic selling, no trying to be clever, just let's see what actually happens. I'm going to show you the real results, not the cherry-picked ones, not the ones that make me look like a genius. All of them, including the one that lost me money. Because here's the thing nobody tells you when they talk about investing. The answer to where should I put my money depends entirely on who you are and what you actually want your money to do. By the end of this video, you're going to know exactly where your $100 should go. Quick note before we dive in, I'm not a financial advisor. I'm just someone who's been investing for a long time, made a lot of mistakes, learned from them, and today I'm sharing what I've actually experienced. Please do your own research. Okay, let's get into it. Let's this fair, I'm judging every investment across 5 categories. Learning curve. How hard is this to actually understand? Passive income potential. Can it make money while you sleep? Tax efficiency. How much of your gains does the taxman take? Risk. How likely are you to lose money? And of course, the results. What is my $100 actually worth right now? Let's start with the one that scares people the most. Individual stocks. The idea is simple. You buy a piece of a company, that company grows, and your piece becomes worth more. Sounds easy, and that's exactly why it's dangerous. Learning curve. I'm calling this high, and I want to explain why, because most people seriously underestimate this. When I pick a stock, I'm looking at 3 financial statements. Income statement. Is this company actually making money? Balance sheet. How much do they owe? How much do they own? Cash flow. Because profits on paper mean nothing if the cash isn't moving. On top of that, who's running the company? What's their track record? What's the brand's position in 5 years, 10 years? This isn't a lunch break activity. Done properly, it takes real time and real research. Now, passive income potential. This is good. $908. The same 100. The same 4 years. 32% down or 900% up. That is the lottery nature of individual stock picking without proper research. And that's exactly the point. If you want to succeed with individual stocks, you have to be strategic, not lucky. But what if you wanted real estate returns without needing to buy a property? That's what we're looking at next. And the passive income potential genuinely surprised me. Real Estate Investment Trusts, REITs. And before you click off thinking, I can't afford property, that is literally the point. Let me give you the simplest explanation I know. Imagine your friend gets 3,000 people to each chip in $100. That's $300,000. He buys a building, rents it out, and splits the rental income every month between all 3,000 people. That's a REIT. You own a tiny slice of real estate, offices, apartment buildings, hotels, shopping centers, without needing a mortgage, a down payment, or a single conversation with a real estate agent. Learning curve, moderate. REITs are genuinely easier to understand than most people expect. You're not dealing with solicitors or property surveys. You just need to understand what kind of property the REIT owns and how it makes its money. Commercial real estate, REITs, offices, retail spaces, warehouses. Residential REITs, apartment complexes, healthcare, hospitals, care homes. Each performs differently depending on the economy, which brings me to something important I'll mention in the results. Passive income potential. Great. This is where REITs genuinely shine. By law, and this is the part most people don't know, a REIT must pay out at least 90% of its profits to shareholders as dividends. Not 20%, not 50%, 90%. That means as long as the REIT is doing well, you get a regular, predictable cash payment just for owning it. For anyone building passive income, this is one of the most reliable vehicles available. Tax efficiency. Great. Same story as stocks. If you hold REITs inside a stocks and shares ISA in the UK or a Roth IRA in the USA, those dividends can be completely tax-free. Risk. Medium. REITs are more diversified than owning a single property. They're spread across dozens or hundreds of buildings, but they're not bulletproof. If the real estate market drops, if buildings sit empty, if interest rates spike, the value and the dividends can both fall. Okay, the results. My $100 in a commercial real estate REIT is now worth $98.59. That's a loss of $1.41, a negative 1.41% return. Before you feel sorry for me, I haven't told you about the dividends yet. Over 4 years, that REIT paid me $11.93 in dividends. So my actual total return? $10.52 profit, 10.52% up. Now that's not going to make anyone rich overnight, but here's the important context. This was a commercial real estate REIT that got absolutely hammered during the pandemic. Offices empty, retail struggling. The fact that I still came out positive thanks to those dividend payments is actually the whole story here. Passive income saved this investment. Okay, you've seen stocks lose money. You've seen REITs scrape through. Investment 3 is the one that completely surprised everyone, including me. Cryptocurrency. I want to be honest with you about this one before we even look at the numbers, because I think crypto gets discussed in 2 wrong ways. Either people say it's the future of everything and you need to go all in right now, or people say it's a scam and you'll lose everything. The truth is somewhere in the middle, and the results of my $100 are going to make this complicated. Crypto is digital money that no government or bank controls. It runs on technology called the blockchain, which is essentially a transparent public record book that nobody can secretly edit. Bitcoin was the first. Ethereum followed. There are now thousands of others. Learning curve, moderate. Here's what you actually need to understand to get started. First, you need a wallet. This is where your crypto lives. Online wallets are convenient but connected to the internet, so hackable. Hardware wallets are offline physical devices, much safer for larger amounts. Second, you need an exchange to buy and sell. Coinbase and Binance are the most widely used. Third, and this is the part most beginners skip, you need to understand tokenomics. How many coins exist? Is the supply limited or unlimited? Bitcoin has a hard cap of 21 million coins ever. That scarcity is a big part of why people value it. Passive income potential, moderate. Unlike stocks or REITs, crypto doesn't pay dividends. But there are 2 ways to earn passive income. Staking. You lock up certain cryptocurrencies to help validate transactions on the network. In return, you get paid rewards. Think of it like earning interest for keeping your money in. Yield farming. You lend your crypto to others and earn interest. Similar to a savings account, but with significantly higher risk. I'll be straight with you. I personally don't do either of these. The risk of platform hacks and coin crashes makes it not worth it for me. I just hold mine on a hardware wallet and leave it. Tax efficiency, poor. And this is the part crypto fans don't love to hear. In most countries, every single time you swap one crypto for another, that's a taxable event. Staking rewards, taxed as income. Trading profits, capital gains. You also can't hold crypto inside an ISA or Roth IRA to shelter those gains. So even if you make great returns, the tax situation eats into them more than most investments. Risk, very high. Prices can increase 1,000% in 12 months and fall just as fast. On top of volatility, crypto has a fraud problem that is genuinely serious. If someone gets access to your wallet or tricks you into sending coins, there is no customer service to call, no fraud protection, no reversals. It's gone. That's not me trying to scare you. That's the reality of an unregulated market. I personally only hold Bitcoin and Ethereum, the 2 most established, because smaller altcoins carry far more risk. Okay, the results. My $100 invested in Bitcoin 4 years ago is now worth $652.24. That is a 552.24% return. I know how that sounds. And I'm not going to pretend it doesn't feel good to say those numbers out loud. But I have to tell you something just as important. That kind of return is not normal. Bitcoin has been the best performing asset of the last decade. Most cryptocurrencies, most of them have gone to zero. Not down 50%, zero. This result is real. The money is real. The risk that produced it was also real. If you're thinking about crypto, start small. Only invest what you can genuinely afford to lose entirely, and treat it as the highest risk part of a wider portfolio, not your whole strategy. Investment 4 is the complete opposite of crypto. Ancient, boring,
and it's been holding value for literally thousands of years.
Like talking about something old and reliable. Gold. This is the one your grandparents believed in, and honestly, they weren't wrong. Gold has been used as a store of value for over 5,000 years. Every great economy that has risen and fallen, gold was there, still worth something, still being traded. People call it a safe haven investment, and that phrase actually means something specific. When inflation rises, when markets crash, when banks fail, gold typically holds its value or even goes up while everything else falls. It's not exciting, it's not going to make you rich overnight, but that's not what it's for. Learning curve? Low. Probably the simplest investment on this list to understand. You have two options. Physical gold, coins, bars. You own something real, something tangible, something that will never go to zero. One note, don't buy gold jewelry as an investment. Sellers add a significant markup for the design. You're paying for craftsmanship, not just the gold. Stick to coins, gold ETFs. These let you invest in gold without physically owning it. On most investing platforms, you can buy a gold ETF the same way you buy a stock. No storage, no insurance, no safe required. Passive income potential? Zero. And this is the honest truth about gold. It does not generate income. It pays no dividends, it pays no interest, it just sits there. Its only job is to hold its value over time. If you're building income from your investments, gold doesn't contribute, it just protects. Tax efficiency? Good. In many countries, certain gold coins are considered legal tender, which can make them exempt from capital gains tax. In the UK, gold Britannias and gold sovereigns currently have no capital gains tax. Gold ETFs held inside an ISA or Roth IRA also benefit from the usual tax protections. As always, check the specific rules in your country. Tax laws change. I'm not a tax advisor. Risk? Medium. Gold is one of the safest places to put money when you're thinking about protecting wealth. It won't crash to zero, it won't get hacked, it won't go bankrupt, but it also won't grow aggressively. That's the trade-off. Safety costs you growth potential. The results. My $100 in gold 4 years ago is now worth $140.10. That's a return of 40.1%. Solid, steady, boring. And in a year when crypto was going through chaos, when some stocks were falling apart, gold just kept quietly climbing. That's not a coincidence. That's the whole point. All right, 4 investments down. The final one is my personal favorite. And if you're watching this wondering where most of your money should actually go, this is probably it. This is the good stuff. Index funds. Let me tell you what this actually is in the simplest way I can. Imagine you could own a tiny piece of every single one of the 500 biggest companies in America. Apple, Microsoft, Amazon, Google, Nvidia, all of them at the same time. That's what an S&P 500 index fund is. One investment, 500 companies, every sector of the economy. When you buy an index fund, you're not betting on one company, you're betting on the entire American economy, and historically, that's been a very good bet. Learning curve? Low. This is genuinely the most beginner-friendly investment on this list. You don't need to read financial statements. You don't need to understand individual companies. You don't need to time anything. You just put money in and let time do the work. Most investing platforms let you set up automatic monthly contributions. So you literally set it up once and forget it exists. Passive income potential, moderate. Index funds don't pay high dividends like REITs, but many of the companies inside the fund do pay dividends, and those get passed on to you or automatically reinvested. Over long periods, that reinvestment, what's called compound growth, is where the real magic happens. Tax efficiency, great. If you hold index funds inside a stocks and shares ISA in the UK or a Roth IRA in the USA, every penny of growth, every dividend, sheltered from tax completely. Over 20 or 30 years, the difference that makes is staggering. Risk, low. I want to be careful with this word, Because low risk doesn't mean no risk. In 2008, the S&P 500 dropped nearly 40%. In March 2020, it dropped 34% in 5 weeks. Those are frightening numbers if you're watching them live. But here's what the data shows. Every single time it recovered. Not just recovered, went higher than before. Historically, the S&P 500 has returned an average of 8 to 10% per year over the long term. Not every year. Some years it drops. Some years it explodes. But averaged over time, 8 to 10%. That's why holding long-term matters so much. The people who panic sold in 2008 locked in their losses. The people who held, or better yet, kept investing through the crash, came out ahead. Time in the market, not timing the market. The results. My $100 in an S&P 500 index fund 4 years ago is now worth $179.57. That's a return of 79.57%. No dart throws, no research, no watching prices every day, just steady, boring, consistent growth. This is why index funds are where the majority of my personal money lives. Not because they're exciting, because they work. Like, okay, let's put all 5 side by side. Individual stocks, negative 32.34%. Could have been plus 808% with Nvidia. That's the range. That's the risk. REITs, plus 10.52%, including dividends. Saved by passive income during the worst real estate conditions in years. Crypto, plus 552.24%. Extraordinary. Unrepeatable. Not typical. Not for everyone. Gold, plus 40.1%. Boring, reliable, did exactly what it was supposed to do. Index funds, plus 79.57%. No research, no stress, no drama, just consistent compounding growth over 4 years. This is the advice they came for. So where should your $100 go? Here's how I actually think about it. If you are brand new to investing, index funds first. Always. Set it up, automate it, forget it, and let compound growth do what it does best. If you already have index funds running and you want to add passive income, REITs are worth looking at seriously. That 90% dividend payout requirement is genuinely powerful over time. If you have a solid foundation and you want to try picking individual stocks, learn how to read financials first. Use a demo account with fake money. Never put more than you can afford to lose into a single company. Gold. I think everyone should have some. Not as your main investment, as protection. When everything else goes sideways, you'll be glad it's there. And crypto. If you want exposure, stick to Bitcoin and Ethereum. Keep it to a small percentage of your portfolio. And never, never invest more than you can lose entirely. The most important lesson from all of this isn't the numbers. It's that starting matters more than being perfect. The worst investment is the one you never made, because you were waiting until you knew enough. You know enough right now to start. Start small, stay consistent, and let time do the heavy lifting. That's how real wealth is built. Not in a day, not in a year, over a lifetime of small, consistent decisions. If this video helped you, subscribe. New video every single week. And drop a comment below. Which of these 5 are you most interested in starting with? I read every single one. See you in the next one.